You ever feel like you've got all the puzzle pieces right there in front of you, but they just won't click until you get that one last bit of info?
Oh, absolutely. Like that final clue in a mystery.
Exactly. That last-minute reveal that suddenly makes everything make sense. Well, today, we're diving deep into the financial world's version of that exact thing. Welcome to the Deep Dive. This is where we sift through stacks of research, articles, you name it, and pull out the insights that matter most to you. Today's topic, something called subsequent events. Sounds a bit dry, maybe, but trust me, it's fascinating. We're talking about these crucial things that happen after a company takes its financial snapshot, the balance sheet date, but before that picture is finalized and shown to the world. Our mission today is to really unpack how companies handle these post-snapshot developments so you get the full story behind the numbers.
And what's really fascinating here, and maybe a bit counterintuitive, is how these events, things that happen after the fact, can actually change how we see a company's financial health at that specific moment in the past. It's less like adding a new photo to the album and more like, say, tweaking the focus on a photo you already took right before you print it, just to make sure it perfectly captures reality. Ultimately, it's all about giving you, the person reading those financial statements, the most accurate, reliable picture possible so you can make informed decisions. These events really bridge that gap, between a fixed date like December 31st and the final truth that gets published. It's key for transparency, for reliable reporting.
Okay, let's really get into the weeds here. First up, what exactly is a subsequent event? Our source material nails it pretty clearly. It says a subsequent event is an event or transaction that occurs after the balance sheet date, but before the financial statements are issued or are available to be issued. That window is everything. Let's maybe visualize that timeline. Think about, say, December 31st. That's the balance sheet date, like the shutter clicking on a camera, capturing that financial moment.
Got it. The snapshot date.
Exactly. Now, everything before that click is obviously in the picture. But then there's this period after the click. But crucially, before that photo is, let's say, developed and printed for everyone to see.
Which is when the financial statements are issued or ready to be issued.
Right. And things can still happen in that gap. Events that might affect how accurate that original snapshot was, or maybe give important hints about the future. That's our subsequent event window.
Yeah.
That time when the company's finalizing things, maybe getting audited, getting everything ready for release.
And like you said, that specific window is just so critical. Why? Because it directly impacts the relevance and the reliability of those financial statements. These aren't just historical documents, right? Investors, creditors, analysts, they rely on these statements for big decisions, allocating capital, deciding whether to lend money. So if something happens after December 31st, but before the statements are out, and it sheds new definitive light on something that was already going on at December 31st, well, ignoring that would basically mean putting out a misleading picture of the past.
That makes sense. You want the picture to be accurate for that moment.
Exactly. The whole foundation of financial reporting is fair and accurate presentation. Subsequent events help refine that view. They make the information you get more complete, more precise for that point in time. It's about making sure the historical record is right, not just rushing to get something published. It boosts confidence, influences decisions. Your decisions.
Okay, so here's where it gets really interesting and maybe a bit tricky. Not all these subsequent events get the same treatment. This is where judgment really comes in. Our sources draw a really important line, dividing them into two main buckets, recognized and non-recognized.
Ah, the two categories.
Yeah. You can kind of think of it like this. Some events tell us more about the past. They help us perfect our understanding of what things were really like on the balance sheet date. While others are more about the future, they signal genuinely new information telling us what's coming down the pike for the company.
That's a great way to put it. Clarifying history versus adding new chapters. So let's tackle that first category. Recognize subsequent events. The absolute key here is that these events give us additional information about conditions that already existed at the balance sheet date.
Already existed. That's the critical part.
Precisely. The underlying situation, the condition, it was already there. Maybe brewing under the surface, maybe partially known. The subsequent event just provides more definite proof or a better way to measure that thing that was already present. So companies have to recognize these. They adjust their financial statements because ignoring them would mean the snapshot of the past is incomplete or just plain wrong.
Let's make this concrete. Our sources give some great examples. First one, settlement of litigation.
Yeah.
Imagine a company, tech innovators. They've been fighting a lawsuit for ages, maybe years. leading up to their December 31st year end.
Okay, a pre-existing lawsuit.
Right. On December 31st, they don't know the exact outcome. So they probably have an estimate on their books, a contingent liability for what they think it might cost them if they lose, their best guess. But then boom, early January, maybe February, after year end, but before the statements are out, the lawsuit settles. Now they know the exact amount they have to pay.
So the uncertainty is gone.
Exactly. And the source says if that lawsuit itself, the dispute, arose before December 31st,
The condition existed.
and it settles in that subsequent window, they have to use that final settlement amount to adjust the liability on their December 31st statements. So if they estimated $5 million but settled for $3 million, they adjust the December 31st liability down to $3 million. And probably record a gain or loss for the difference too, right?
Absolutely. And the why is crucial. The condition, the fact that they were liable or potentially liable, existed on December 31st. The settlement didn't create a new problem. It just gave the exact measurement for the old problem. It perfects the historical snapshot. You know, auditors love this stuff. They look for this kind of objective evidence that comes out after year-end to confirm or challenge management's estimates from year-end. It protects you, the investor.
That makes total sense. Precision matters.
Yeah.
Okay, another classic example. Loss on an uncollectible receivable due to bankruptcy. Let's use our case study company, Friends of Fido. Say they had a customer who owed them a lot of money on December 31st, and maybe those invoices were already pretty old, way past due.
Okay, so red flags were already there, aged receivables.
Exactly. Suggesting maybe the customer was already struggling financially, even if they hadn't declared bankruptcy yet. Then, in January, after year-end, the customer officially files for bankruptcy.
Right. So the source says the bankruptcy filing has to be considered when figuring out the uncollectible amount for year-end. The key is that the customer's inability to pay, or at least serious doubt about it, was already a condition at year-end, shown by those aged invoices.
So the bankruptcy is just the final nail in the coffin, confirming what was likely already true.
Pretty much. It's the definitive confirmation. So Friends of Fido would need to adjust their allowance for doubtful accounts and record more bad debt expense on their December 31st financial statements. This makes sure the balance sheet reflects the true value of receivables at that date, and the income statement shows the correct expense for that period. It's all about historical accuracy.
So just to sum up the recognized ones, they're recognized because they help the financial statements show the true financial picture at the balance sheet date. It's like cleaning the lens on that camera after taking the picture but before printing it, using information that clarifies what was actually in focus at the moment the picture was taken.
Couldn't have said it better myself. Perfecting the snapshot, not adding new scenery.
Okay, now let's flip the coin. Let's talk about non-recognized subsequent events. These are totally different. They provide information about conditions that did not exist at the balance sheet date. These are genuinely new things, new developments.
Exactly. They might be hugely important for the company's future, but they don't change the financial picture as it was on December 31st. The condition just wasn't there then. Our sources list several common examples. Think about the sale of bond or capital stock after year-end.
New financing.
Right. It changes the company's capital structure after December 31st. They didn't have that cash or that debt on the balance sheet on December 31st from that specific transaction, or a big business combination, like an acquisition announced or completed after year-end.
Buying another company.
Yeah, that's a major new undertaking, a future event. They didn't own that subsidiary on December 31st. And remember the litigation example. Here's the flip side. Settlement of litigation, if the litigation itself arose after the balance sheet date.
So if the whole legal issue started after December 31st?
Correct. If the lawsuit didn't even exist at year-end, its settlement later can't possibly tell you anything about conditions at year-end. It's a new problem entirely. Also, things like a loss of plant or inventory due to fire or natural disaster, these are sudden, often unforeseen events happening after year-end.
Like a warehouse fire in January.
Exactly. The warehouse was fine on December 31st. The fire doesn't retroactively change its condition on that date. The financial hit is for the new year.
What about market stuff, like stock prices or exchange rates changing after year-end?
Good question. That falls under changes in the fair value of assets, liabilities, or foreign exchange rates. These are market movements after the snapshot date. The value on December 31st was what it was. January's value is January's news.
And new deals, like signing a huge contract in the new year.
That's covered too. Entering into significant commitments or contingent liabilities. These are new promises or potential obligations taken on after the balance sheet date. They didn't exist at year-end. And finally, that other receivables one. Loss on receivables resulting from conditions occurring after the balance sheet date.
Okay, how's this different from the bankruptcy one we called recognized?
Great question. It's subtle but crucial. In the recognized case, the customer was already showing signs of distress at year-end, those aged invoices. Here, imagine a customer was totally fine, paying on time, everything looked good at December 31st. But then, in January, something new happens. Maybe a specific disaster hits only their business, or a sudden industry collapse.
So the reason they can't pay rose after year end.
Exactly. The condition of uncollectability wasn't there on December 31st. It's a new development causing the loss. Auditors look very closely at the timing of the underlying cause.
Okay, so if these non-recognized events don't get adjusted into the prior year's statements, does that mean companies just, ignore them, pretend they didn't happen?
Absolutely not. This is where the focus shifts entirely. It moves from recognition, adjusting the numbers, to disclosure, telling people about it in the notes.
Disclosure. So talking about it.
Right. If a non-recognized subsequent event is material, meaning it's important enough that leaving it out could mislead someone reading the statements, then it must be disclosed. Transparency is key.
And what does that disclosure look like? What do they have to say?
They need to explain the nature of the event. What actually happened. Was it a fire, an acquisition, a new lawsuit? And then, crucially, they need to provide an estimate of its financial effect. How much might it cost? What's the potential impact on future results?
What if they can't estimate the cost?
Good point. If they genuinely can't make a reasonable estimate, they have to state that. Just say, we can't estimate the financial effect right now. Our source also mentions something interesting. Presenting pro forma financial statements.
Pro forma?
Yeah.
What's that?
It's like a what-if scenario. They might show a version of the balance sheet presenting the effects of the non-recognized event as if it had happened on the balance sheet date.
So it doesn't change the official December 31st numbers, but it gives you a glimpse of what they would have looked like if this big new thing had happened then.
Exactly. It helps you visualize the impact without messing with the historical accuracy of the primary statements. It's a balance.
So disclosure keeps everyone informed about major future impacts, even if the past numbers don't change.
Precisely. It ensures transparency about these significant new developments without making users think the condition existed back on the balance sheet date. It provides that crucial forward-looking context. Companies walk a fine line here. They need to be transparent, but without causing unnecessary panic or misinterpretation about past performance. It's about giving you the full picture, past reality, plus important future context.
That makes a lot of sense. It's quite a balancing act. Okay, this brings up a really practical question. How long do companies keep looking for these events? Does the clock just run indefinitely?
No, thankfully not. That would be chaos. There's a defined subsequent event evaluation period, a specific cutoff point. And the timing, the actual end date for that evaluation period, depends on a key factor. Does the company file reports with the SEC, the Securities and Exchange Commission?
So public companies versus private ones.
Generally, yes. For SEC filers, typically your large publicly traded companies, they have to evaluate subsequent events right up through the date the financial statements are actually issued.
Issued means when they're officially released to the public.
Exactly. Often when they file them electronically with the SEC, making them publicly available, they keep looking right up until that moment. Makes sense, right? Public investors need the absolute latest info. Now, for all other entities, think private companies, nonprofits, etc., the rule is slightly different. They evaluate subsequent events through the date the financial statements are available to be issued.
Okay. Issued versus available to be issued. What's the precise difference there?
Good distinction to make. Financial statements are considered issued when they're formally distributed to users in a format complying with GAAP, generally accepted accounting principles. Think of it as the public launch.
Like the movie hitting the theaters.
Perfect analogy. Now, available to be issued is a bit earlier. This is when the statements are complete, GAAP compliant, and all necessary internal approvals have been obtained. Management, the board, whoever needs to sign off, has signed off.
So the movie is finished, approved by the studio heads, ready to go, even if it's not playing everywhere yet.
Exactly. It's the internal green light, the point where they could be issued. And this difference matters for disclosure, too. If you're not an SEC filer, you must disclose the date through which you evaluated subsequent events.
You have to tell people the cutoff date.
Yes, and you have to specify which date it was the date they were issued or the date they were merely available to be issued. This gives the reader, you, a clear boundary. You know exactly what period was covered by their subsequent event review.
But SEC filers don't have to make that specific disclosure.
Correct. Our source says they don't. It's mainly to avoid conflicts with other SEC rules, which generally imply evaluation continues right up to the public filing date anyway. The assumption is built in for public companies.
Okay, that clarifies the timeline. Now, sometimes things go wrong or rules change and financial statements need, well, a do-over. What happens when statements are reissued or revised?
Great question. Let's talk about reissuance first. This is when a company puts out a new version of financial statements for a prior period that they had already issued before. The general rule here is pretty clear. They should not recognize events that happened between the original issuance date, or available to be issued date, and the date they reissue the statements.
Why not?
Think about it. If every new piece of information that came up after the statements were originally finalized could force an adjustment to those old statements, it would create total chaos, no finality.
Financial statements would be constantly changing.
Exactly. A moving target. It undermines the integrity of reporting for that original period. You need stability. Now, there is an exception. An adjustment is required if a specific accounting rule, GAAP, or a regulator demands it. Like if a new accounting standard comes out and says, apply this retroactively.
Okay, so unless a specific rule forces their hand, they don't update old reports for new events that happened way later.
Correct. Preserve the original snapshot's integrity.
Got it. Now, what about revised financial statements? How are they different?
Revised statements are issued specifically to correct an error found in the originals or to apply a new accounting principle retrospectively, meaning changing how things were reported in the past.
So fixing a mistake or adopting a new rule that affects past reporting.
Exactly. And here's the key link. Revised financial statements are considered to be reissued financial statements. They fall under that same umbrella.
Ah, okay, so the same principles apply.
Pretty much. And because they're considered reissued, there's a specific disclosure requirement, again, mainly for non-SEC filers. When they issue revised statements, these non-SEC entities have to disclose the dates through which subsequent events were evaluated for both the original statements and the revised statements.
So you see the cutoff date for the first version and the cutoff date for the revised version.
Exactly. Provides a clear audit trail for the user. And again, our source notes this specific dual date disclosure isn't required for SEC filers. It really just underscores the whole point. Striving for accuracy and transparency, even when correcting the record. You know when the information was finalized both times.
Okay, wow. We've covered a lot of ground definitions, the two types, the crucial timeline, what happens with reissues. My head's spinning a little.
It's definitely a lot to absorb.
Let's try to make it stick. Let's apply all this to our case study company, Friends of Fido. Remember, they're an SEC filer. Their year end is December 31, year 3, and they plan to issue their statements by the end of March, year 4.
Okay, so their evaluation period runs right up through that March issuance date.
Perfect. Let's walk through some events that happened after December 31st, year 3. Event number 1. Remember that lawsuit filed against them back in year 2? Well, it finally settled in early February of year 4. Friends of Fido has to pay $600,000. Their December 31st statements had estimated this liability at $725,000. What's the verdict here? Recognized or non-recognized?
This one's pretty textbook. It's a recognized subsequent event. Why? Because the lawsuit itself, the underlying condition of being potentially liable, clearly existed back on December 31st, year 3.
It was already a known issue.
Right. The settlement in February didn't create a new problem. It just provided the precise final dollar amount for that pre-existing problem. It turned an estimate into a fact. So Friends of Fido must adjust their December 31, year 3 financial statements. They'll reduce that liability down from $725K to the actual $600 case settlement amount. It makes the historical record more accurate.
Okay, recognized. Makes sense. Event number 2. In early March of year 4, Friends of Fido announces a big move. They're going to acquire another company, Doghouse Inc. The deal is for $1.5 million in cash and stock, and it's planned to close later, in September of year 4. What about this? Does this change their December 31st numbers?
This one's clearly a non-recognized subsequent event. The plan to acquire Doghouse Inc., the agreement, it all happened after December 31st. The condition earning or being obligated to buy Doghouse simply did not exist at the year-end snapshot date. It's a future strategic move.
So no adjustment to the December 31st statements, but it sounds pretty important.
Absolutely. It's definitely material.
Wow.
So while they don't adjust the old numbers, they must disclose this planned acquisition in the notes to the financial statements. They explain what's happening, the price, the timing. This gives you, the reader, crucial information about a major future change, even though it doesn't affect the past financials directly.
Got it. Disclose, don't adjust. Okay, event 3. Remember that customer with the significant age invoices at year-end? The one who seemed like they were already struggling.
Ah, yes, the one with the red flags.
Well, they officially declared bankruptcy in January of year 4. How do we handle this?
This one goes back to being a recognized subsequent event. That phrase, significant aged invoices at year-end, is the key. It strongly suggests the condition the customer's likely inability to pay already existed or was rapidly developing at December 31st. The bankruptcy filing in January is just the confirmation.
Proof of the pre-existing condition.
Exactly. So Friends of Fido needs to adjust their December 31st numbers. They'll increase their allowance for doubtful accounts and recognize the bad debt expense related to this customer for year 3. It corrects the year-end picture.
Okay, recognize, because the problem was already evident at year-end. Now, event 4 is similar, but different. Listen closely. Friends of Fido had another customer with invoices outstanding at year-end, but this customer was usually a timely payer. No red flags. Then, in February year 4, this customer suffers a catastrophic flood, wipes out their business, they decide to close permanently, won't return calls. Looks like Fido won't get paid. What now?
Ah, this is where the distinction becomes critical. This is a non-recognized subsequent event. And there are really two key reasons. First, unlike the previous example, there was no evidence at year-end that this timely paying customer wouldn't pay. The condition of uncollectability didn't exist on December 31st.
They seemed fine at year-end.
Right. Second, the cause of the problem, the devastating flood and the decision to close, happened entirely after year-end. These were new events. So this doesn't provide information about conditions at year-end. It's a new problem arising later.
So even though the outcome is the same,
Mhm.
Fido probably isn't getting paid. The timing of the underlying cause makes all the difference.
Precisely. It's about whether the root condition existed at the balance sheet date. Here, it didn't.
Okay, so non-recognized. Does it need disclosure?
Well, that depends. If the amount owed by this customer is material significant enough to matter to someone reading the statements, then yes, Friends of Fido should disclose it. They'd explain the situation, flood, closure, and the potential loss in the notes. But again, no adjustment to the December 31st financial statements themselves. If the amount isn't material, no disclosure is needed.
That comparison really highlights the subtlety, doesn't it? It's all about when the condition truly arose. What about something like a product recall? Say, Friends of Fido makes toys. In January year 4, they discover a serious flaw in a toy sold all through year 3. By February, they know a recall is needed. The flaw was there in year 3, but they only found out and decided to recall in year 4. Recognized.
Ooh, that's a great tricky one. Typically, that would still be treated as a non-recognized subsequent event.
Even though the flaw existed.
Yes, because the condition that actually creates the liability, the formal obligation to recall, the point where it becomes probable and estimable usually doesn't happen until the company discovers the issue's severity and decides a recall is necessary. In your example, that discovery and decision happen in year 4. On December 31st, year 3, while the flaw was latent, the actual recall obligation hadn't crystallized yet.
I see. So no adjustment to year 3 statements.
Correct. But obviously, a major product recall is hugely material, so it would absolutely require extensive disclosure in the notes. They'd have to explain the recall, the estimated costs, everything. It's crucial future impact information.
Okay, last one for Friends of Fido. What if, in mid-January year 4, their board approves a 2-for-1 stock split, effective in April year 4? How's that handled?
That's another non-recognized subsequent event. A stock split changes the number of shares in par value, but not the total equity. More importantly, the condition of having double the shares didn't exist on December 31st. The board's decision, the trigger, happened after year-end.
So no adjustment.
No adjustment to the core financial statements for December 31st. But like the recall, it's definitely material information for investors. It affects per-share data significantly, so it absolutely must be disclosed in the notes. They'd explain the split, the ratio, the effective date. And importantly, they usually have to adjust per-share amounts like earnings per share retrospectively for comparability. Disclosure is key here.
Wow. Okay, from defining subsequent events to splitting them into recognized and non-recognized, nailing down that evaluation period, handling revisions, and then walking through all those Fido examples, it really shows the layers involved.
It really does. It's not just plugging numbers into a spreadsheet.
It's this whole process of ensuring the final financial statements are as reliable and useful as possible, reflecting the past accurately while signaling important future changes.
That's the heart of it. All these rules, these distinctions, the focus on disclosure, it's all designed to give you, the user of those statements, the clearest, most accurate, most transparent picture possible. It's about balancing that historical accuracy, what was true at that moment, with timely information about significant things that have happened since, things that affect the future. It empowers your decisions.
So next time you're looking at a company's financials, maybe pause for a second. Think beyond just the numbers printed on the page. Consider that hidden timeline stretching just beyond the balance sheet date. What subsequent events might have shaped those final figures? Did they clarify the past, or are they signaling big changes ahead? What does that extra layer tell you about where the company truly stands, not just then, but now and heading into the future?
That's the deeper understanding we hope you gain.
Definitely food for thought. Keep digging, keep doing your own deep dives into financial literacy. The more layers you understand, the clearer the whole picture becomes. Thanks so much for walking us through this complex topic today.
My pleasure. It's important stuff.
And thank you all for joining us on the deep dive. We'll catch you next time.